Oh, hello guys, and welcome to my channel where I translate technical accounting lessons to a storytelling version, sort of. And today we're going to talk about notes receivable accounting already. Imagine? But in order for you to relate or follow the lessons in this video, you have to take a look at first my notes payable accounting series. So their links are made available on the description below. And you need to click them now. Click it now. Okay? And assuming that you already watched those episodes, then I'll assume that these possible questions right here, and this illustrative problem, and this completed timeline, and these journal entries are already familiar to you. So it needs to be familiar with you because we need to compare this notes payable accounting to the notes receivable accounting. Okay? Now, in the notes receivable accounting, if we follow this the same illustrative example, we are simply just going to change our point of view to Papa G's point of view. So in the past episodes or in the past videos, we have been assuming Baby G's point of view. Well, today we are Papa G and we are the ones who received this promissory note from Baby G. So the question is, how do we account for this promissory note? That's the main question as Papa G. Okay? And the short answer is, first, in the valuation, there will be no changes. The note receivable will still be valued based on this cash price. And the computation for the effective rate is still the same with the past episodes. And basically, everything in this timeline is still applicable. Now, what's different? What's different are the journal entries. So every journal entry that you will see here will be reversed. For example, instead of this debit interest expense, the entry of Papa G will be credit interest income instead. And instead of notes payable, notes receivable will be recorded. And aside from which, if in the entries here, the notes payable is debited by Baby G, Papa G will credit notes receivable instead. Meaning, not only the account titles are changed, but also their placements as debits or credits are also reversed. And normally, the debits here are credited by Papa G, and the credits here of Baby G will be debited by Papa G. Like for example, this credit cash here, this will be debited by Papa G because if Baby G recognizes this as payment, that's why it's credited here, Papa G recognizes this as a cash receipt. That's why it needs to be debited by Papa G. Okay? That's it. Now, how about the possible questions? The possible questions are still the same and are still applicable. Like in this possible question number 1, you can still be asked about the effective rate and the answer will still be 11% if we have the same problem. Except if Papa G incurred a unique direct cost because such direct cost will be added to the notes receivable. And if that happens, then the notes receivable initial balance will be affected. It will be this cash price plus the direct cost. And if that happens, the effective rate will change. So that's it for possible question number 1. On question number 2, the only thing that will be changed is this notes payable. It will be changed to notes receivable. And that is also the case for question number 3. The question can still be asked, but then again, instead of this notes payable, it will become notes receivable. In possible question number 4, instead of interest expense, you will be asked about interest income. And in question number 5, you can also be asked this question, but instead of interest payable, you are going to be asked about interest receivable. Although the concept is still the same. If the interest payable is based on the nominal rate or the agreed rate, the interest receivable also is based on the nominal rate or the agreed rate. Okay? Possible question number 6 and 7 are also still applicable. And also, the last 3 questions are still applicable, except that instead of notes payable, everything will be changed to notes receivable. Okay? And that's it for accounting for notes receivable and the possible questions. But I would like to add something. These possible questions can be added with what is the impairment loss and questions or other things related to impairment. Okay? Because notes receivable also, the same with the loans receivable and other receivables and other investments can be impaired. Okay? So, regarding that, I have in the description links related to the impairment of loans and the expected credit loss model because again, it is still applicable to notes receivable. So I would like you to watch them after this video because the topics again in those episodes are also applicable in the accounting for the notes receivable. Okay? And assuming that you did it, let's revisit this illustrative problem and let's use it in our next topic, which is the discounting of own notes receivable. We are now on the discounting own notes receivable topic. Okay? So what is this? This is basically, in simple terms, selling your notes receivable to someone because you need money and you can't afford to wait for the maturity date or payment dates. So for example, someone wrote to you a promissory note for 1 million and it is payable after 1 year, for example. Now, after 8 months, for example, you badly needed some money because of an emergency. So, you cannot wait for the payment date. And if that's the case, you have an option to sell the promissory note to someone. And that someone can be a bank or other financial institutions. And that someone, that bank, that financial institution, will then give you money. But such money that you will receive is discounted already or is lesser already than what you are supposed to receive, which is logical because the buyer of such receivable needs to earn from the transaction. Okay? Now, the act of selling the promissory note is what we call as discounting own notes. So that's discounting own notes. But we are going to talk about that in depth in the next episode. So if you wanted, you can study in advance about discounting own notes so that you can easily grasp and master the topic. Okay? So let's end this video to keep this short. Okay? So thank you for watching, and if you learned, please don't forget to subscribe, like, share this video, and click the notification bell and select all to never miss an upload. Again, thank you for watching and see you on the next one.